Market is selling off once again, so let's get right into the market outlook. We're seeing the S&P 500 in the sustained downtrend since we topped mid-November. We're seeing that continued weakness. We look at the heat map. We're seeing tech with the continued weakness. The big mega cap tech stocks are getting killed. We're finally seeing energy come in a bit. And now we're seeing a shift. We're seeing a rotation towards more consumer defensive names, the healthcare stocks, and then the financials are starting to bounce today. We have a huge Fed meeting this Wednesday where they're expected to raise interest rates for the first time since 2018. They're only going to raise it a quarter point. So it shouldn't, in theory, shock markets too much. And my thinking of this market is I think we were a little bit spoiled with the COVID bear market. I'm going to zoom back to that time. And if we look at the COVID bear market, it was 33 trading days of selling. It was very fast until we bottomed. It was a whipsaw move. It was very panic selling. And now what we're seeing here is just kind of a sustained downtrend. We can stay in this environment for months and months until something dramatically changes. And if we listen to how the Fed was speaking, they were much more concerned about not having equity markets puke. They weren't really concerned about them pulling back. They were like, as long as they don't puke, we're kind of fine with the mandates and that sort of thing. So, we can remain in this downtrending environment for months to come until we see, some sort of major change in the environment. That's what I'm kind of going to plan on. Simple as that. We're finally seeing energy come in a bit. Is it a one-day pull-in, or is it, is it a top? I'm not sure about that. What are your thoughts over there, Bennett?
So it's funny you mentioned like the slower pullback, which we were doing like a little lesson. I was doing a lesson video with Heaven and a few of the members in the lower groups, and it was that we were talking about the same thing where we were kind of gifted, as scary as it was for most during that little 1 month crash, that one would expect the future pullbacks and corrections of bear markets to be just as quick, if not quicker. And now we're starting to see Mr. Market say the opposite. It's like, no, now we're going to make this very slow, just like you said, very slow, and more painful that it's going to take longer than most would expect. But definitely agree. Again, energy definitely got a little, blow off top-ish. Utilities, no surprise that they're retesting their prior all-time highs again. Utilities are going to be like that flight to safety when the market's not doing so hot. People are going to gravitate towards that space, so it's not too surprising to see that little retest there. With the mid and small caps, both look extremely weak. They're both almost identical chart-wise. We had this amazing run-up and this big consolidation that, for the most part of the year, we were expecting a breakout and continuation higher, and now we're seeing the opposite of that. So with this small and mid-cap space, seems like a big void once they take out those key support levels. For MDY, for example, it's 450. Underneath that, you can easily expect like a breakdown into the 400 area, which would take you into the kind of the 200-day. And same with the mid-caps, under this like 188 like key level of support. This little H pattern that's forming more likely is going to resolve lower and break under the 200-day and see us back like that 160 area in the short term. So for the most part, seems less is more continues to be the overall theme.